Everything in this video is not intended as financial investment advice and is for educational purposes only. I'm Josh Olszewicz, head of research at Valkyrie, and let's take a look at the midweek market update. Last week we had a 25 basis point raise at the FOMC meeting. Tomorrow, Wednesday, we will have a CPI print for the previous month, looking like it's going to be about unchanged, maybe plus or minus 0.3% between CPI and core. If we look at Truflation, it continues to break lower on a year-over-year basis. This doesn't mean inflation is better over the long term. It just means year-over-year it's down significantly. And if we look at the specific categories, one of the biggest categories that we're seeing these declines is in the housing category. And we also know that the BLS data for CPI is quite lagging by up to 6 months. So it may take some time still to get the Truflation data to filter through the government CPI data. If we look at the rate probabilities for the next meeting in about a month from now, the general sentiment is they're going to hold rates here. Some of the regional banking stuff has cooled as they floated a short selling ban on regional banks or the banking sector specifically. No serious discussions there publicly, at least, but it was enough to sort of turn the tide in the nearest of terms. Now, it doesn't affect maybe what some would argue as the inevitability of deposits continuing to leave regional banks for greener grass that is higher yield in the form of money market accounts or other competitors' yield products. In any event, just because the stocks are doing better doesn't necessarily mean that the sector health has improved. So if CPI is slightly hot, expect these probabilities to tip towards another hike or more hikes. If CPI comes in softer than expected, expect these probabilities to continue to shift to the left here towards cuts. The Fed has continually said, we're not going to cut this year. We don't see that in the cards. It's not going to happen. I don't know if they can not say that. I mean, they have to say that because otherwise the market's just going to go berserk, assuming we're just going to see cuts, right? So I think up until the week or two that we actually see a cut is when we get a cut. So I think these probabilities continue to be optimistic, but if you assume there's going to be a recession or a hard landing, then you'd argue the Fed has to start cutting. So we'll see what they do, but this continues to be extremely optimistic. I'm going to start with gold here on the TradFi TA side of things because gold continues to look phenomenally strong in the face of debt ceiling talks, banking problems. I think gold strength is really good for crypto because it sort of illustrates the digital gold correlation quite well. And just based on TA, there's zero expectation that this is bearish in my mind. This should lead to some sort of breakout eventually. It's definitely taking its sweet old time, but it's a legacy instrument. We tend to see very, very slow moves in legacy instruments. DXY also sort of biding its time here between 100 and 102. I think when we definitively see a path for cutting, we will see the DXY decline because Europe and other places around the world in this basket of currencies continues to deal with inflation much higher than the US, which means they're likely to continue raising or keeping rates higher relative to the US, in my opinion, but we'll see what happens. And the S&P doesn't seem to care what's going on in reality. If your view is the S&P should reflect the fundamentals, I don't know if it does that exactly. Maybe the alternative viewpoint is the S&P reflects the forward fundamentals or 6 months from now. It's trying to price in what's going to happen, which is why things are fairly muted here. Again, this looks on a technical basis to me, plenty of room for upside, plenty of likelihood for higher highs. For the same reasons Bitcoin looks bearish to me, which I'll get to in a second, S&P looks bullish. It keeps knocking on highs, keeps trying to make higher highs. It has not made a higher low. Sorry, lower low. There be dragons below 40.40. Until we're below 40.40, I definitely have a strong bullish bias on the S&P. And this is the regional banking ETF, KRE. Since 2014, it's kind of had three major patterns, I guess 4 if you want to count this W double bottom during COVID. But if we measure the patterns, just like we're measuring gold, we're taking the depth of the range, projecting it higher, assuming it's bullish, projecting it lower, assuming it's bearish. And it gives you an ideal zone level target, however you want to think about that, potential for where this move should go. And we had a megaphone, we had a Head and Shoulders, and now we have another Head and Shoulders that we're currently in the midst of delving within the zone of profit taking. You know, if you're just trading the technicals, right? Matching this with the fundamentals, knowing that maybe regional banking continues to struggle a little bit based on those fundamentals. Things may not be quite done here. Interesting how that lines up much of the time, that the technicals and fundamentals definitely talking to each other. So this does not look like, thus far, you know, a healthy bottomy chart where you'd expect this thing to reverse in a strong manner. Now, you could argue that historically this has been a level where buyers step in, but to me, does not look like anybody wants to catch this knife just yet. Even Buffett has said, you know, he's staying well away from banking equities at this point in time. As we move on to the next crisis, which is the debt ceiling, the debt limit showdown. And it's interesting that the coin keeps talking about minting this $1 trillion coin, sort of resolving the debt, assuming that's going to solve the problem. There's also talk of premium bonds, which would be issuing low principal bonds, which would effectively be below the debt ceiling, but adding a very high interest payment onto that. And that would mean they would sell for more beyond the principal, and the treasury would make money. It all sounds kind of silly, but one of these things is bound to work if an agreement isn't reached. And as Bloomberg sort of points out, we're in the midst of when a deal could happen. If we look at the calendar, these next 7 days, where all three of the key parties are available. So if we get to the 17th and we don't see a deal yet, we may be in trouble on that front. I think both sides are dug in. Both sides want what they want. I don't see any immediate plans to reverse course from either side there. And just sort of doing an around the world in the regulatory realm, we're seeing a lot of investment go to Europe on the crypto side of things because of the regulatory clarity there. That certainly has helped relative to the United States or elsewhere, where there's much more hostility towards crypto companies and businesses. Looking to Argentina, where they appear to be banning crypto outright because of the inflation in that country, essentially acting as capital controls where they're not allowing citizens to off-ramp. Now, at the end of the day, if it's a peer-to-peer transaction, that's impossible to actually censor. But if you're using an on-ramp or an off-ramp to do this sort of thing, or a centralized payment service, the government very easily can shut that down. So that's why it's important to rely on decentralized services for things like this. We, of course, have Binance, Binance.com, Binance US, dealing with what could be quite the legal trouble in regards to sanctions violations. I don't think it's a secret that Binance.com has generally been a great off-ramp for people who are involved in illicit crypto activities. That's just what I see based on chain analysis, that sort of thing. It's not a secret. So to see DOJ, SEC, whoever else going after Binance for this sort of thing is also not a secret. That doesn't mean the market's not going to sell off when this eventually hits, even though everybody sort of knows it's coming. Again, in my mind, this sort of aligns with the technical picture for Bitcoin at the moment, for altcoins especially, which are getting crushed, potentially in light of this. Moving on to Zimbabwe, they're issuing a gold-backed digital currency, which is very interesting. The key component here, of course, being who's going to vault the gold. Is the vault decentralized? Is the vault unconfiscatable? You know, that's the key with any sort of backed stablecoin like this. Kind of an interesting experiment. There's already, of course, Tether Gold, which exists backed by gold. But it's interesting to see governments continue to sort of experiment with this type of technology. We had Liechtenstein announce this week that they will allow payment for certain services in Bitcoin directly, which is very cool, and where we start to develop that closed loop ecosystem in that you get paid in crypto, you can spend crypto, you can pay your taxes in crypto, you can pay your mortgage in crypto, you can buy your coffee in crypto, right? For many of us, that has always been the end game, where we can sort of exit this fiat system entirely, assuming the government would allow for that. And kind of on the opposite end of the spectrum, we have China continuing to, the South China Morning Post used the word promote, but I think it's more forceful than promote, strongly encourage citizens of China to use the Chinese central bank digital currency. And on the digital asset side of things, we've got some interesting experimentation, let's call it, on our hands. Now, I personally think all this stuff is purely speculative. I'll use a technical term, garbage, but the protocol on Bitcoin allows for it. And there may be something down the road where we see a use case for this sort of thing. What you're looking at here is a list of BRC20 tokens similar to ERC20 tokens on Ethereum. Not exactly the same, but similar, where anyone can essentially issue an NFT with certain stipulations, supply, limit on minting, that sort of thing. And then people can go and pay for creation of these NFTs. After that, there is a secondary market, allegedly, potentially. I've yet to see anybody talk about the wild profits that they've made on any of this stuff. I take all this market cap and volume information with a grain of salt. But this type of potential profit is alluring many to mint these NFTs on Bitcoin directly. And we know that's the case because average transaction fees are rising extremely high. Glassnode reporting average fees around $30. I think it's up even slightly from that. The interesting thing with Bitcoin is, yes, there's a certain amount of space in each block, megabytes, that you can fill as a user, as a community. As that block space gets closer to the block limit, that fee gets more and more expensive. So it creates this fee market. On top of that, if you send a transaction that is below a priority where you don't get included in the next block, you can replace that fee with a higher fee. So if there's a reason to have a super high priority when you're sending a transaction, as a group, as a block, you can push those fees higher and higher and higher over time. That's partly what we're seeing here. We're seeing a lot of people want to transact very quickly, and that is pushing fees, average fees, very high. Total transaction fees actually nearing an all-time high, eclipsing 2021 and nearly eclipsing what was 2017, 2018, that late period in December. The difference between 2017, 2018, and 2021 highs in fees is this is not based on direct Bitcoin speculation. This is based on speculation of assets on top of Bitcoin. So that's why you're not really seeing a price effect directly per se like you have previously. And if we look at the fees priced in Bitcoin, we can see the halvings here. Every 4 years there's a Bitcoin halving. The next one's coming sometime in March, April, May of 2024. And we can see miner revenue. This is fees plus block reward for this period of time past the halving has reached an all-time high for this halving period. So because of the spike in fees, miners are doing extremely well since the last halving priced in Bitcoin. I think it's important to think about both denominations because a lot of miners hold on to the BTC when things don't look as bearish. Some miners sell all the BTC they get every single day. Some miners don't. So some miners, if price goes higher, may have an amplified effect here if they're holding BTC, for example, because they're getting more BTC on these fees. And another thing that's super important is eventually the Bitcoin block reward will cease to exist and miners will have to rely solely on fees. And as many have argued, maybe rightfully so, that much of the time Bitcoin has had very low fees, very low need for expansive block space, and the security budget effectively has been very low or limited. So seeing the transaction fees actually exceed the block reward, which for a few blocks that did happen, this gives more than a thought experiment to what we could see down the road, very much a reality. We've seen it happen in the wild. Whether or not we'd actually see continued high priority for layer one transaction remains to be seen, but the percent of revenue coming from fees has also likely hit an all-time high. The only other time close was 2017, 2018 historically. So miners doing extremely well in this period. And another way we can sort of slice and dice this is looking at transactions per day. In this case, a weekly average of transactions per day, also reaching an all-time high. And another thing we can look at is the average transaction size, which I'll do that in a second. But we're seeing an unprecedented amount of people, again, minting these NFTs. I don't understand it, but that's what people are doing. And one other sort of side effect to all this activity is unconfirmed transactions, which are waiting in what's called the mempool. And the blue here is lower transaction fee transactions, and each level here is higher and higher fees. So if you want to send a transaction with a low priority, you use a low fee. If you want an immediate high priority, you use a higher fee. Over time, this will clear, as it has many times before it and many times after. So this isn't a permanent issue, but in the near term, if you're trying to send a transaction, it's definitely going to be more expensive than it usually has been. And one of the other side effects of high fees is you're sort of pricing out other types of transactions. If you're not involved in this speculative activity, if you don't need to send transactions, you're not going to. If you are trying to send a $30 transaction and it costs a $30 fee, you're not going to send that transaction. So we're seeing active addresses actually drop during this period. And that for me is the main reason why we're seeing that. And if we look at average size of transfers, this sort of says everything to me, because yes, over time, as price rises, you're going to see a rise in average size of transfers. But unlike any sort of banking stuff that's going on, sort of pushing urgency to move big amounts of crypto around, we're seeing average transfers just plummet, right? Because a lot of these transactions are extremely small in relative value. We can also see the number of inscriptions or NFTs that are minted over time. You can see absolute hockey stick over the past few weeks. Fees paid, absolute hockey stick. And where this is happening is an exchange called Unisat. Again, you can see the volume, you can see the transactions. The way this is sort of set up is users need to mint several NFTs effectively to then participate in a minting program. This to me is akin to transaction mining, which I won't get into, but it sort of gooses the volume and effectively makes the fee market more and more expensive. I don't know why they have it set up like that. There may be a good reason, maybe to prevent spam, but there's all these other side effects to that. Moving on to technicals for Bitcoin. This is really what I've been focused on for the past couple weeks, the potential for some sort of head and shoulders reversal pattern. Now, if you would have asked me on Friday, how do we look? I would say we look great. We're at the top of the range. We're ready to break higher highs. Over the weekend, we plummeted 8 to 10%. We're currently at lows. We've made this M double top type of fractal within the right shoulder. All of this to me looks bearish, because we are setting ourselves up for a breach of 27,000, which just again measuring the depth and expecting a bearish breakdown, that's where we're headed. So until we're back above 28, let's say, then the bias is, for me, bearish here in the near term. And we also broke down below another sort of smaller time frame consolidation, suggesting lower lows. So there's just nothing here to me in the near term that looks like we're ready to push higher highs. It very much looks like there are more sellers than buyers. Zooming way out, things look fine, right? When in doubt, zoom out. Multi-year power law corridor definitely suggests to me that we are closer to a bottom than a top. So there's no concern there from that perspective. But in the near term, what we'll probably see on the cloud is a test of cloud support, a test of the Kijun. We may even see a bearish TK cross, may even see an edge-to-edge move to 24.5 or thereabouts, 23, 24.5. Again, this does not look like a bullish breakout. This does not look like we're breaking above the daily cloud. This does not look like we're seeing a bullish TK cross. So until we start to see that, it's hard for me to be bullish in the near term. Now, the good news is Bitcoin loves mega deep retraces. This is 2015 to 2018. And we had extreme retracements over and over and over again throughout that rally. And one thing this does allow is for people who felt like the move got away from them to re-enter the market. So I would argue deep retracements in a bullish environment is actually a really good thing, because it helps and leads to further continuation. And another way we can sort of slice this from, let's say, year to date is a pitchfork that, again, is showing some problematic evidence here if you're bullish, because really the most important line in the pitchfork is the midline. And you can see since SVB blew up in depositors got rescued, we've held this bullish stance above this half of the pitchfork. And over the past couple days, we've been below that midline. So again, my stance is trend remains bullish near term. An increasingly likely chance we start to delve lower here in this pitchfork. Moving on to some ETH information. Not too much has changed here. Really the big thing for ETH lately is the net flow into staking has flipped positive. We can see a majority of the withdrawals have slowed. Most of this was Kraken, and that appears to be done in the moment. Looking at ETH waiting to exit, it is very low now at 133,000 ETH. And at this point, it looks like most of the people who wanted to get out have gotten out, or most of the people that had to have exited have exited. No issues on that front from the staking department. But looking at on-chain activity, still somewhat muted, somewhat flat. ETH fees are higher, much like Bitcoin, because of sort of meme coin stuff on top of the chain, not necessarily people directly using Ethereum. So transactions arguably, flat year to date. You could say, well, this is a year to date all-time high, I guess, in transactions per day. Averaging this out, it would probably be flat. Active addresses, flat. Nothing super exciting going on there. Here's the fee chart. Average transaction fees, if we zoom in a little bit, slowly starting to pick up again. And because fees are up, you're also seeing a rise in daily ETH burnt, which means we're taking supply out of circulation. So despite all of the seemingly rosy things that are going on, fundamentally, money is flowing into staking and ETH is being burned, you have not seen that show up on the USD chart at all. We've remained in the range, chopped around, much like Bitcoin. There's really no expectation of a move higher here until we start to break above 2,000. That's all for this one. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All the opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.